Welcome, everyone. I'm very pleased to be welcoming you to this webinar on closing deals during the COVID-19 period. We are now live, but we are just going to be patient until more participants join us. So I will just ask you to show a little bit of patience. I can see the numbers of participants rising very, very quickly. And so I think that in a few seconds we'll be able to start. I welcome you all once again to this new webinar, which theme is Closing Deals and the Impact of COVID-19. What can we foresee in the pipeline? My name is Anne-Marie Diaz-Borges, and I'm a journalist with the BBC in London. I'm very happy, of course, to be welcoming you all. As you would have noticed, this is a webinar which will be entirely in English. And we are very happy to be presenting you today with a truly Pan-African discussion. Indeed, we'll have keynote speakers from the Maghreb region, but also from various countries of sub-Saharan Africa. And this webinar, I have to mention, is the second in a series of 6 webinars dedicated to business leaders operating in Africa, and around the consequences of COVID-19. And this is a series organized by, of course, the Africa CEO Forum in partnership with the international law firm Azevedo & Co. So before entering really the heart of the discussion, there are a few informations that I have to share. Remember that you have the opportunity to ask questions in writing during this conference. There is, in fact, to that effect, a Q&A tab at the bottom of your screen. So please, I'd like you to go and check that. I will then submit the questions that you have asked to our panelists, and they will, of course, if time allows, answer your questions. And also, it's a great way for you to contribute to our discussion today. Also, your opinion is essential. So a couple of surveys will be run through today, and you will receive prompts at some point on your screens. And of course, I totally invite you to give us your opinion, and then I will give the results at the end. Also, be aware that you can also choose the display that you prefer, and to that, there is a tab at the top right of your screen. And finally, please share and comment on social media using the hashtag ACFDigitalEvents. You can see it on your screen. So dear sirs and gentlemen, the COVID-19 pandemic, we know, has greatly impacted global mergers and acquisitions. They were down by 40% in value in the first quarter of this year, and projections actually predict a gloomy picture for the rest of the year. Still, amidst the current legal blockages and the strong economic uncertainties, this can also be a time for business opportunities for companies with deep pockets. So the question here today really is, how do we turn the tide? And to discuss, we are with Riëtte Engels-van, director at Azevedo & Lotens. We are also in company of Sofiane Lahmar, partner at Development Partners International, and with Fred Mourimi, managing director at Centum Capital. And we'll also have 2 great testimonies from 2 very special guests during this seminar. They are Toyin Sanni, Group Chief Executive Officer at Emerging Africa Capital Group, and Esther Omulele, partner at MMC Azevedo. But first, I give the floor to Miguel Azevedo, Head of Investment Banking, Middle East and Africa at Citigroup. Prior to joining Citigroup, Mr. Azevedo was a senior country advisor for BAML and an executive director at Goldman Sachs. Mr. Azevedo, I welcome you.
Thank you very much, Anne-Marie. Thank you very much. It's a pleasure to be here. I will be taking you through 5 short slides, and maybe we can have the first slide on the screen. And here, what I try to show our audience is our views in terms of what was happening before COVID. What were the driving factors behind M&A, but also capital raising in emerging markets and in Africa. First was the search for sustainability. Remains very important, although it may not be top priority in Africa. But it's very important if you need to raise capital outside the continent. The second is a search for growth. And here we all understand why Africa is center stage. Clearly one of the regions with more growth, but also very important to highlight that execution is difficult in Africa. No point in avoiding that. Third element was search for efficiency. Companies were looking to consolidate, governments were looking to monetize assets. So this was all driving new business. It's still very valid, and I could argue that efficiency in Africa is actually where the gain can be bigger. The fourth element was search from China. China was very big in terms of financing, in terms of buying, in terms of even investing. And that has been the case for the last 10 years or even more. Some excesses in the past may come to the fore now. So very interesting to see what happens post-COVID. And final, and more to my specific area, emerging market valuations were very depressed. Equities were very low, which means cost of equity was very high. However, debt was abundant. Nearly anyone could raise debt, and it was very cheap. So there was what we call de-equitization. There was people changing equity for debt. That is gone. That doesn't exist anymore. In 2 months, completely disappeared. And the key element is what we call the micro premium versus macro discount debate. Micro premium is the companies that do business in Africa, raise capital, do M&A, are all very good. And they have survived many, many challenges, and they have thrived. However, the macro discount is always there. Deficient macro policies, economic policies creates a discount. And it's the debate between these two that at the end of the day, in the last few years, led to what people call the Africa discount. I believe that this is an opportunity to reset. And let me show you on the next slide what has happened in the last 2 months, which is not great, but is probably an opportunity as well. If you look at the bond yields for sovereigns in Africa, North and South, Egypt and South Africa, they went up by 100 basis points, 1 percentage point more expensive. East and West, Kenya and Nigeria, 200 basis points. And I'll give you the example of Angola, which went up by 800 basis points, massive. So this is basically making debt more expensive. But equity risk premium, which is what investors demand to invest in equities, went up more or less across the board by 600 basis points. South Africa being different as in many other instances. But this is massive. This is 700, 800 basis points increase in the cost of equity. If you have a company and you discount that, you value the company at 15% discount rate, and then you have to move to 20%, these 500 basis points, the value of the company roughly goes down by 1/3. So this gives you a sense of the impact in, if you want, wealth destroyed. On the next slide, I start addressing what's in the future. And the good news, and I cover both the bond, the equity, and the strategic capital M&A markets. The good news are that the debt capital markets are back. They have been back for a few weeks worldwide, but in Africa, they reopened last week. We did an issue for Egypt that was very well received. And we now believe that investors are willing to buy sub-Saharan Africa sovereign bonds again. This is fantastic. If you had asked me 2 weeks ago, maybe we would have been a bit more cautious. On the equity side, we don't see transactions coming yet, but there's a sequence. And if the bond market starts, we can see the equity market starting maybe only beginning of next year. And on the M&A strategic capital, it's more or less the same. I think investors are on pause. We will see later on, doing due diligence, working from home is very difficult, traveling is difficult. So I would say next year is probably the right time. And in the next slide, I will share with you how I try to see, what has happened in the short term, but more importantly, what needs to happen in the long term. In the short term, we have seen, 5 actions, put it that way. We have seen governments and managing the liquidity for the countries with the support of the IMF and the World Bank and all that. We have seen the starting of the discussions around debt restructuring, very important. We have seen government intervention, we have seen financial packages, and we have seen the checkbook being used. But this is short term, this is liquidity driven. What is really important is the long term, is having the continent and the companies and the countries solvent. For that, you need equity investment. And that can only happen, that is necessary for growth. And that can only happen if the governments have the right discipline, the right policies, and they don't crowd out private initiatives. And we also need to see better governance packages and what I would call a checklist. Some time ago, someone told me, the Chinese come with a checkbook. The Europeans and the Americans come with a checklist. We always go for the checkbook. Well, it may not have worked that well in the past. So maybe checkbook plus checklist is the right thing for the future. And for deals to restart, I would use the next slide to drive you through 5 key elements that I believe, in summary, we need in the near future to see so that business is back in Africa in very sustainable manner. The first one is obviously a functioning world economy. Deglobalization is not good for Africa, and hopefully that will not win. The second element is the debt situation of Africa has to be sustainable. There has to be some standstills for sure, but also reprofiling and restructuring of debt. That is not easy, but is necessary. Third, countries need once for all to implement solid economic and industrial policies that favor investment, that favor capital expenditure, investor friendly. And as number 4, I argue in favor of a one-off development fund that needs to be funded by the rest of the world to kickstart the economies in Africa. This could be, say, $100 billion over 5 years, supported by US, Europe, and China, to really get the economy going and creating the jobs that everyone needs. And as a practitioner, the final point I would make today is that success breeds success. And so you need successful companies and entrepreneurs to come to the market, raise capital, deliver on the promises, and create money for investors. And let me stop here, hopefully around the 8 minutes I have been given. And over to you, Anne-Marie, again.
Thank you very much, Mr. Azevedo, for your beautiful insights and quite a few strong keywords there and punchlines. Success breeds success. Also a big emphasis on sustainability, because indeed this is what we want to see for Africa, sustainable businesses. I now turn to our illustrious speakers, which I briefly presented at the beginning of our webinar, but now I have the pleasure at presenting at greater length. Ladies first, we are in company of Riëtte Engels-van, director at Azevedo and Lawtons. Mrs. Engels-van is furthermore an expert in legal matters, including mining tax law and export law. She is also part of the brand new Azevedo and Lawtons team based in Johannesburg, South Africa. And this is a result of a recent alliance between the two law firms, Azevedo & Co. and Lawtons. Mrs. Engels-van, please be welcome. We are also in the company of Sofiane Lahmar, partner at Development Partners International. Mr. Lahmar has over 13 years of experience in the sector of private equity in Africa, notably in private equity investments, as well as in M&A, investment banking, and option trading. Mr. Lahmar, please be welcome. Thank you. And we are finally in the company of Mr. Fred Mourimi, Managing Director at Centum Capital. This is a division of Centum Group. Mr. Mourimi furthermore oversees Centum's strategy through the development of investment-grade opportunities across key sectors. Mr. Mourimi, welcome.
Thank you.
And I would like to start with you, please. Centum Capital has massively expanded over the last 5 years, greatly diversifying, notably between the years of 2014 and 2018, especially in Uganda. And you have even doubled your assets during that period. I would like to ask you, Mr. Mourimi, how has this pandemic affected your activities? And also, has it changed your strategies?
Okay. Thank you very much, Anne-Marie, for the question, and good afternoon to all. So thank you for that introduction. Indeed, Centum Capital has been very busy in this region, in the East African region. We've possibly been amongst the more active private equity fund managers in this region. We've had quite a number of investments as well as exits in this region. I think for the East African region, for those maybe not too familiar, I think we've seen fairly stable economies, very good consistent growth in GDP, also fairly stable political environments. And those are very important elements for any investor into the region. They say that capital is a coward. So it's useful when you have very stable and safe conditions. Now, looking at what this pandemic has meant for us, I think there is two issues that we are alive to. Number one is that we have the public health issue of the corona, the COVID-19, of course the infection rates and the mortality rates, and we've taken the view that the public health issue is going to be with us for at least another 12 months. We're looking back at similar global viral pandemics that we've had. None has taken a shorter period than 14 months to deal with. So we think we'll be dealing with the public health issue. Maybe the end might be a vaccine being found, but it's going to be with us for some time. There is then the economic issue. The economic issue is being caused, not because there's a fundamental problem with the economies, but because of a slowdown in economic activity caused by the public health issue. I think when we've seen similar financial crises in the past, these have gone through possibly a 24 to 30-month cycle before markets recovered back to where they were. So for us, what this has meant is that we are now pretty much at the precipice of a cliff, if you like, and I think we still have a way to go before we get to the bottom. For us, it then means we are continuing to look for different investment opportunities. We're having lots of investment discussions, and so we're still active in the market.
Thank you very much.
We have, however, of course, have to slow down and just see us get to the bottom of this crisis that we're in. Thank you.
Thank you. Thank you very much, Mr. Mourimi. And I'll turn to you, Mr. Lahmar. Your company, Development Partners International, is one of the rare companies to have closed a deal during this period. And I have to mention that it's quite a huge deal because DPI has announced last week an investment of $55 million in the agribusiness company SICAM in Tunisia. This was an operation which was launched before the crisis and closed in the middle of it. May I ask you, why didn't you choose to delay this deal? And how did the crisis affect the price that you had established?
Thank you very much. Thanks, Anne-Marie, and it's a pleasure to be here. And thank you very much for your question. Indeed, a very relevant question. Look, I think in general, just by way of background for us at DPI, we are one of the leading private equity investors across the continent in Africa. All we do is invest in Africa exclusively. So that's all we look at. We don't invest on a global basis. And so we're really kind of following, the impact on the African continent and the various countries in which we invest. And I think in general, our view has been, as a result of the COVID-19 crisis, to be much more selective and to try and have as much visibility as we can get on transactions. The CCAM transaction that you mentioned is one that we had been working on for over a year. We had been on the ground, obviously, multiple times in Tunisia. We had done very detailed due diligence the way we do on any given transaction. And as a result of the crisis, we took a very hard look at the impact on the business, and ultimately, took the view that given the industry that it's in, which is very much focused on food production, which is an essential industry during this COVID-19 crisis, it was one of the very rare industries in our mind that is not only defensive and resilient to the type of crisis that we're going through, but may actually, in fact, benefit from the current situation, in the sense that people are in some ways consuming more essential food and staple food products on the one hand. On the other hand, given some of the disruptions that we've seen in supply chains internationally and including in Europe, it has given CCAM the opportunity to accelerate its international expansion and export strategy in Europe and other international markets. And so I think as a result of all of that, when we looked at it on a net-net basis, we felt that the business was well positioned actually to capitalize on the growth opportunities, and the investment thesis remained intact, and we were comfortable proceeding on that basis. As it relates to valuation, it didn't actually fundamentally change. The financial performance of the business has been very strong throughout the crisis so far. And as I mentioned before, we felt confident that the growth opportunities remain intact and they can capitalize on those. And if anything, we think they will be able to accelerate those growth opportunities, certainly as it relates to their export strategy.
Thank you very much. Thank you very much, sir, for
Sure, my pleasure.
For all these precisions. I would like now to advise you that our first survey is going to be showing on your screens very shortly with the first questions. And once again, I do emphasize the fact that your opinions are very dear to us. So please do take a second and reply. You can see the questions on your screen right now. And I will give the results of this survey in a short while. Now, I would like to turn to you, Mrs. Engels-van. Of course, I can imagine that your clients intending to invest on the continent are really wondering with this situation how to have a precise idea on how to value assets. Now, I would like to know, how are they trying to overcome this difficulty, and what is your precise role in this process, please?
Thank you very much for the question. Yes, indeed, we've seen our clients applying a wait and see element. Some of the deals definitely have halted as a result of that. Although we have seen that when it comes to pricing, there's been an increase from our clients, and that'll be both government and external parties looking towards refinancing. And in particular, when it comes to pricing, arguing for lower rates on borrowing. So the interest on the borrowing element, not just from the banking side, but also asking what is going to be the long-term yield or lookout from a tax perspective, because it always is tax follows the facts. Will there be a different aspect to how debt will be deducted or allowed to be deducted? So that's one of the leading aspects when it comes to price, and specifically on the client side. So we've seen an increase from government clients that are looking to refinance some of their assets now, and they've put out those necessary conversations with us with specific questions. We haven't seen the external market yet approach, and we'll probably see that happening if I look at my inbox coming towards the second part of 2020.
And may I ask you, you know, in these uncertain times, what are the factors to bear in mind when we have to price an asset? What do we have to really bear in mind?
Right. So when you look at the price of the asset, you would historically look at how it has been doing in its financials, but then you would also be forward looking towards those turnouts, right? And those turnouts are now obviously factored by variables. It's not just the turnover that you're going to see varying as a result of the slowdown because of the public health issue, but you'll also see it in specific sectors of industry. And then an adjustment, as we've seen in either an interim worldwide or external tax policy for the African countries, which we've seen across the board for 6-month period or 8-month period, which does affect the financials and the pricing elements, or you're going to see that in the longer haul, which we're anticipating from our side if we look at those elements that we have to comment on legislatively.
Thank you very much. And now I turn to Mr. Mourimi. I just have another question as well. I would like to ask you whether the tools that you usually use really to generate the use of value in a business, are those tools still relevant today since the conditions have dramatically changed?
Super, thank you for the question. So for us, what we've seen has generated for us a very good return over the last 10 years. As primarily we've been able to drive operational efficiencies in the businesses that we are invested in. And that continues to be, I think, a very useful tool even as we go through this COVID-19 season. We've seen, of course, because of reduced demand across different businesses, they may possibly also have to make some short-term decisions, suboptimal decisions to conserve cash. And as we then come out of the crisis, there'll then be opportunities to get businesses back to an operationally optimal level. So it may be around people, it could be around reestablishing relationships, creating new supply chains, maybe across making new investments in plants. So there's lots of opportunities we see that as we come out of the crisis, gives us the opportunity to keep turning those levers around operational efficiency. And so for us, I think this crisis, I think, gives us that opportunity. We were there in 2008, 2009, after the global financial crisis, where businesses came out not necessarily strong out of the crisis, but that then presents an opportunity for investors to be able to drive return in the businesses.
Thank you very much. And I'd like Mr. Lahmar to extend the same question to you. Are the tools that you usually use still relevant today?
Sure, no, absolutely, Anne-Marie. I think from a valuation and pricing standpoint, you know, most investors, at least in the private equity industry, we use very standard tools, whether it's public, you know, comparable analysis or DCF or looking at precedent transactions in a sector. All of those valuation tools and methods are still very relevant. We would apply the same methodology. I think it's more the impact that we've seen. So if you look at public market valuations, those have definitely come down, you know, along the lines of the decline that you've seen in all the major global equity indices. So that's a real impact. If you try to do the so-called, you know, discounted cash flow analysis on any business today, depending on the industry again, but for most businesses, they've seen an impact, and it's still too early for them to be able to reassess their new business plan, their new 5-year forecast, and therefore it's hard at this stage to, you know, be able to perform that type of analysis or do it on the same basis and with the same visibility and level of confidence that you would have had maybe 2, 3, 6 months ago. And so I think all of that has to be taken into account. And except for very few industries, as I mentioned before, that are more defensive and therefore less cyclical and, you know, move less with the economic cycle, and there you have more visibility and more comfort to price and proceed. For other sectors, it's basically delayed all of the deal activity by at least 6 months, if not a year, going into 2021. And I think by then we'll have not only more visibility on the economic and business outlook, but we will also hopefully have great opportunities to invest at very attractive valuation. And so I think for investors such as ourselves who have dry powder today in this kind of environment, we're really looking forward to some very attractive investment opportunities in the coming year to 18 months.
Thank you very much. Thank you very much, Mr. Lahmar. I would just like to give you the results of our first survey. So 70% of our respondents answered, so 70% of you, sorry, took part. 30% answered yes. 45, as you can see, well, it's actually 29% now, it's gone down slightly, answered yes, and 46% said no. Impossible to say for 18%, and very interestingly, 7% don't have an opinion for now. Well, I'll just remind you that a second survey will take place very shortly. But as you can imagine, the situation has been particularly difficult, or let's say, interesting the least in Nigeria, which is Africa's biggest economy. The West African country has notably been affected by the collapse of oil prices, and it's had to devalue the Naira by 15% in March. And so to discuss, it is now my pleasure to turn to Mrs. Toyin Sanni. She is Group Chief Executive Officer at Emerging Africa Capital Group, which is a group which provides advisory, trust, agency, and wealth management services. It also facilitates investment on the continent. Mrs. Sanni, please be welcome.
Thank you very much, Anne-Marie. It's a pleasure to be here.
It's a pleasure to have you with us. Mrs. Sanni, may I please start by asking you which of the issues addressed so far are the most relevant for the situation in Nigeria?
Typically, for a deal to take place, you want to have fair certainty as to the valuation of the assets. And valuation typically is a feature of both the past performance of the stock, of the investments, and the projections as to the future. Now, past performance is not relevant because this is performance before COVID-19, and there are significant customer behavior changes. And at the same time, the future is very hard to project. And so this has created a rather wait and see approach to deals and transactions. So that's one of the most relevant points that has been made earlier today. Thank you.
Thank you very much. Thank you very much. So how has the pandemic affected large pipeline deals in your country, please, Mrs. Sanni?
Well, the pandemic within West Africa, for example, I can say a major deal that would have been about $8.8 billion in the oil and gas sector has had to be shelved simply because, I mean, the principal party, one of the oil majors, pleaded force majeure. And this is one of the impacts that we have seen in West Africa as a result of the uncertainties around COVID-19 and the significant crash in oil prices. So you know that Nigeria is an oil revenue dependent economy from the perspective of the government revenues. And so the major crash in oil prices as a result of COVID-19 shutdowns, as well as the trade war, price war, has had a massive effect. But then the good part, though, is that we have not seen as huge valuation depression in the stock market as we thought. And so from about minus 20% in March, our stock market has recovered to minus 6%. So those are the recent developments in our market.
Mm-hmm. So it's very interesting to see that, you know, amongst all these big changes, there is still a glimmer of hope. Mrs. Sanni, I did mention that part of your duty is to advise investors and large groups. I would like to know, what are you advising those large groups at the moment? Is it a good time to push or to postpone or maybe close deals?
It's a good time to wait. And it's a good time to scout for opportunities. Where, for example, you see a cash-strapped business, that is willing to do a deal at significantly depressed prices, and you want to look at backward integration, for example, because of what has happened to the supply chains globally, or you are looking to expand your business and you happen to be a cash-rich investor, then I would say look at it and push for as good a deal as you can get.
Mm-hmm. So my follow question, which comes quite naturally actually, is what can we expect post-COVID according to you?
Post-COVID, we expect a recovery. And like I said, because in Nigeria, for example, in asset prices and the equity markets, we seem to be seeing that our market may be more resilient than we had thought at the beginning. So I think it will be a modestly fast recovery. It would still be a U-shaped recovery, but we will get there. And I would say that opportunities will open up even as the economy, and we will not wait till the end of COVID-19, as the economy begins to open up. You remember that one of the things we have seen is that the impact of COVID-19 across Africa has not been as devastating as we thought it would be. So we're looking at recovery of activities, first from the debt market and then on to the equity markets.
So looking ahead, of course, it's very difficult not to mention the Africa Continental Free Trade Area scheduled for July the 1st. But of course, we have to mention a likely postponement. What consequences can we expect, Mrs. Sanni, from such a decision?
Wow, it would be disappointing, but it is not unexpected. And the consequences obviously would be that it would impact intra-Africa investments and trade, which we would, like to see, being driving up. But over time, hopefully the postponement will not be too long.
Thank you very much, Mrs. Sanni. And I have to mention that unfortunately, we've gone all digital and we've had to suffer the consequences of a slow connection, but your message was well received, loud and clear. Thank you very much for your contribution.
Thank you.
And I really take this opportunity to mention that Mr. Wankele Mene, the newly sworn in Secretary General of this African Continental Free Trade Area, will be among our key speakers during our next webinar on June 11th. And I will give you the theme at the end of this webinar of our next webinar to which Mr. Mene will take part. And he will actually be able to answer, of course, all your questions on the implementation of these free trade areas and also the consequences of the crisis. But now it's time to move on to the second part of this our discussion. And before that, I'd like to mention that a second poll will screen in a few seconds. And again, please take the time to answer the questions. And just like in the first part of our webinar, I'll be giving the answers very shortly. So please just take a second to do that. And so our second part of the discussion now is about how to initiate, conduct, and also complete an acquisition, which can be pretty tricky in these troubled times. And I will start with one of the questions that was sent by a member of the audience. His name is Kevin Ekalufo. He's CEO of Astra Ionos Capital. And Mr. Ekalufo is asking, how do we integrate operations of the troubled competitor we plan to acquire without a drop on performance? A very fitting question to be asking today. Mr. Murimi, will you be the first to answer this question, please?
Okay, thank you. Thank you very much for the question. Yeah, so I think part of the strategy during these times is then looking at competition and whether there are possible M&A opportunities with competition. It has the effect of reducing competition in the market, which I guess is a strategic move for a player to make in these times. It also affords the opportunity to growing businesses to scale up even faster. The challenge, however, of course, for any business looking at M&A opportunities in this season is trying to distinguish, to separate the wheat from the chaff. There could be businesses that would have struggled even in spite of COVID-19, and you possibly do not want to be acquiring weak players that would have struggled anyway. The challenge will then be to identify the players that will actually complement and add value to what you're currently doing. Thank you.
Thank you. Thank you very much. And again, I extend the same question to you, Mr. Lahmar, and Mrs. Engels-van. Would you like to give your point of view as well? Mr. Lahmar?
Yes, yeah, no, happy to do that. Thanks, Anne-Marie. Thanks for the question. Look, what I will say, to me, a company in this kind of environment should only consider at buying a competitor, and certainly if they're looking at a weaker competitor, a troubled company, they should only do that if they themselves are in a strong financial position and have quite a bit of cash on balance sheet and are very strong from a liquidity standpoint. That's very, very important, because if they're going through their own issues, I think it's a major distraction for management to try and look to integrate another business, let alone an underperforming business that needs turnaround. And then secondly, I think it's very important, in addition to that, that the team that's looking to acquire has the capabilities and the capacity to actually go through an M&A process and integrate properly. Because if they don't, I don't think it's the kind of environment where you're necessarily seeking to build that type of capacity within your team. I think it's really an environment where there's already quite a bit of pressure going on from a macro environment. So if you don't already have that skill set and that experience and that track record of successfully integrating acquisitions, then I would also probably wait and see and be very cautious about doing this. But in general, and we are having these types of discussions with many of our portfolio companies, and some are looking at acquisitions. They are not looking at acquiring underperforming, troubled companies, I have to say, because I think that would be a bit too much to take on. They are looking at more, companies that are sound, that are performing reasonably well, and that do provide a unique opportunity in this environment to either consolidate market position or have vertical integration, or capture synergies that are quite significant, with a clear view on value creation and a clear vision for the combined entity, and again with a clear capacity within the team to undertake such a project, which can be a major distraction.
Mm-hmm. Mrs. Engels-van, I see you having a strong reaction to what you've just heard. Would you like to give us your take on this, please?
Yes, that's very much correct. We have been advising our clients that are looking to acquire competitors not to take this on in this, shall we say, troubled economic time or uncertain economic time at the moment, to rather focus on their own businesses and what could be foreseen for the next 6 to 12 months. But for the one or two clients, shall I rather say two clients that have looked into their competitors, specifically the one question that has come up across the board is competition law, and the question whether you can acquire your major competitor in this business or one of your major competitors in the same line of business, or even across industries, and whether that would be permitted, just in a general sense, and how long that permission would take, because the acquisition would need to take place very seamlessly from that perspective.
Thank you very much. We have another very interesting questions from one of our of the people in our audience. This is coming from Mr. Kunle Elubute, chairman of KPMG Africa, and is asking, do we foresee most deals being done virtually, and for how long? This is a very interesting question in these times where everyone is turning towards virtual solutions. Who would like to answer this question? Mr. Lahmar, please. Yes, thank you.
And we keep asking ourselves, the same question. The reality for us, from a very practical standpoint, we're unlikely to complete deals virtually unless like we just did last week when we completed the CCAM, acquisition and investment, I should say, into CCAM in Tunisia, unless you had already done all the work pre-COVID and had a chance to go on the ground and performed all of the DD and all that, and you're just doing some final steps on a remote and virtual basis. But otherwise, for the new discussions that we're having at the moment and the new deals that we're considering, we're trying to advance them as much as possible on a virtual basis by Zoom calls and what have you, and other video conference capabilities. But I think from there to something more meaningful and ultimate closing, I don't see that happening until the international borders and international travel resumes. Because for us, at least in our business of private equity, I think it's different for public market investors, obviously, because they do invest on a desktop basis. But for private equity investors, being on the ground, being able to visit management in person, visit the facilities, go around the country is critical to what we do. And until we can do that, we will not be able to complete, transaction just completely virtually.
Thank you very much. And I have another question at the moment for Mr. Mourimi, please. And this is also coming from one of the people who are following us. Their name is Jean-Michel Riëtte, partner at Keys Finance Partner. Mr. Mourimi, this gentleman is asking, how do you expect COVID-19 to impact due diligence processes?
Thanks for the question. And I think it's pretty much tied to the earlier question. So there's quite a bit of due diligence work that can be done virtually. Particularly we're talking about review of financial statements, attempting forecasting to the extent possible. I think there's quite a bit review of documents, corporate information. There's quite a bit that can be done virtually. And already, I think in the context of deals, a lot of that is already done virtually. However, there's a huge aspect of due diligence that really revolves around people. And people here include the management of the target company. You also want to speak to customers. You want to speak to suppliers of the target company. And it's true what they say, that 90% of communication is nonverbal. So what COVID means is that now that aspect of the human interaction as part of the due diligence process is definitely restricted. So it makes it that much harder to be able to complete a due diligence and to be able to really get a good view of the people side of the business. I think the other aspect of due diligence that is coming up is around the forecasting. If you look back, say the last 100 years, there have been 7 viral pandemics dating back to the Spanish flu in 1918. Of these 7 pandemics in the last 100 years, 4 of those pandemics have been in the last 20 years. So we are seeing an increasing regularity of viral pandemics recently. And so even after we get out of COVID-19, this will not be the last of viral pandemics that we see. So I think a new area of due diligence then is really around stress testing businesses to find maybe you will be able to survive this one viral pandemic. Will you be able to survive the next 1 or 2 that come in the context of a 5-10 year investment horizon? That of course makes it that much harder, but of course, as always, cash is king. So I think there'll be a real stress testing around cash in due diligence.
Thank you very much, Mr. Mourimi. So I would like to take the opportunity now to give you the results of our second poll. The results will be on your screen very, very shortly. And I'm sure, so the question was, when the COVID-19 crisis is over, which sectors will attract the most interest? Interestingly, and that will be of very good interest to you, Mr. Lahmar, agribusiness is 61% of the votes. Very interesting. Transports and logistics comes next, 34%. And we know that this is an area which is so important on our continent. And I'll be asking you what you think of those results, actually. I would like to remind you that you have the opportunity to contribute to this discussion, to be an active member of the discussion using the Q&A tab, which is at the bottom of your screen. So please be asking your questions, and I'll make sure that I'll take them to our distinguished guests and they will be able to answer. Also, I would like to remind you our hashtag, which is ACF Digital Events. Please take the time to share on social media and bring us your point of view on all the topics that we are discussing today. And so to have further insight into the mechanics, the challenges, but also the opportunities to close merger deals during this pandemic, I would like to introduce now Mrs. Esther Omulele. She is partner at MMC Asafo. Mrs. Omulele has extensive experience in mergers and acquisitions, as well as structuring real estate and mixed-use developments. Mrs. Omulele has advised several major companies, and she has also been ranked as a leading lawyer in Kenya in real estate. Mrs. Omulele, be welcome.
Thank you.
Thank you very much. And I will leave you the floor now for your presentation.
Thank you, Anne-Marie, for this opportunity. And good evening to our participants. My presentation is on how COVID-19 pandemic will affect mergers and acquisitions going forward. The panelists have already discussed the commercial aspects of it. So my presentation will be from a legal perspective. So one of the areas, a typical M&A transaction starts with due diligence. And as my colleagues have said, one of the areas where buyers and their consultants will have to be particularly careful in conducting due diligence is in the financial piece. So for the financial DD, there's a question as to whether the revenues of the target are likely to remain as they were, before COVID, or what will be the effect of this pandemic to the revenues of that company. The other thing is around customers and suppliers. So for customers, do they still have the same capability to buy or seek for the services that the target company has been providing going forward? Then for suppliers, if it's for a company that relies on physical products being delivered, is that possible? Are the factories open so that then they can supply? Then looking on to operations and contracts, there's the question as to whether the target can continue to honor the obligations under particularly the material contracts. Will there be breach? If there's breach, will there be penalties, or will there be litigation that follows breach? Then the question of the employees, do they have access to their offices? Can they work offline where it is, production planned? Is that even practical to do? That interruption in terms of time, what does that do to the numbers of that company? Then the other one would be around insurances and whether the insurances cover instances of pandemics. From a review of the insurance policies, you'll find that pandemics have not yet been included, but hopefully then going forward, insurance companies can begin to think how is it that they can price that as an insurable risk. Having done the due diligence, the next thing is about price, and the price would be on the next slide. And the thing about price is currently we have transactions that started before COVID, like Sofiane talked about the deal that they just closed. So the question then becomes, will the parties consider a rethink of the price based on what is happening now, and can they open those contracts? Can they renegotiate and see in light of what is happening? But for transactions that then haven't started or in the process of being negotiated, then the parties may want to think about how to bridge the gap in relation to valuation, because right now it's not the easiest of things to arrive at a value that is accurate or close to accurate. So they could introduce measures such as deferring payment of a portion of the price until a later date, or they could allocate purchase price risk to the sellers by structuring a portion of the price to be paid in the form of an earn-out or a future payment. Then for deals where private equity buyers are concerned, they may want to roll over a portion of the price so that it is paid subject to performance of future obligations or depending on how the company performs. Then the next slide, please. We look at the timelines of completion. How will that be impacted? And here the advice to buyers and sellers is that they consider, just lengthening the time within which these transactions will close. And it's for various reasons. Most of them have been mentioned before, like you have people working from home, the ease of just, information being passed or being available online. Is it all available at the same time? Then the other thing is around travel restrictions. Like if there's an asset that has to be valued on site and the valuer cannot travel, then of course, then it would mean there's delay in terms of completing that transaction. Then the other thing is around obtaining consents from third parties, and particularly in jurisdictions where it is necessary that consents be given in writing and be signed off in original signature. Then it therefore means that you may have to wait until all of this pandemic is over or the restrictions are lifted, and therefore that increases the time within which transactions close. Then around the registries, can you conduct searches when you're doing your due diligence? Can you file your transfers? Are the registries open? That's another concern. Then regulatory approvals. Are the regulators available? How long will they take them to evaluate the information that is sent to them, particularly bearing in mind that most regulators currently have very few employees on site. So those would then mean that when buyers and sellers are negotiating a deal, if it was to take 6 months, they may want, in the normal that we knew before COVID, they might want to have a longer completion period. Then the other thing is for sellers. A lot of the agreements would have a provision that the seller should continue to operate in the ordinary course of business. Now, if a seller has this sort of covenant, then how do they fulfill that covenant, bearing in mind what is happening right now? The pandemic has meant that the working capital has been affected, and therefore if a seller has covenanted to operate in the normal course of business, there could be breach, and therefore sellers may want to have pandemics, as an exception to that covenant. And then for the buyer, what does that do? If that is the ordinary course of business requirement is removed, what does that mean for the buyer? Then the other clause that parties will have to think about is the mark clause and also the force majeure clause. And for the mark clause, for the sellers, you need to think about excluding pandemics or maybe restrictions that may come as a result of the changing laws from the definition of your mark clause. Then for buyers, what do you do in that instance? Because it could mean that the value you hoped to buy is eroded over a very short period of time. Do you have an option to exit the transaction if indeed the effect of the pandemic exceeds a certain limit? So just thinking about that so that then you have a clause that is balanced and is fair to both parties. Then on force majeure, these are events that are beyond the control of both parties. You may want to include this pandemics as one of the events that could impact the transaction. Then moving on now to the next clauses that parties will need to be very careful about. It's on representations and warranties. Now, where a seller has represented and warranted that, in respect of various things, then there could be situations such as compliance with laws where you find a seller is not necessarily able to even confirm that they will comply with all the laws, because as we speak, laws are being enacted on an ongoing basis, on a need basis, as the pandemic evolves. So therefore then, that sort of seller would need to be careful and to the extent possible disclose as much as possible, so that then whatever is disclosed is excluded from the representation and warranties.
Thank you.
Yeah, then finally is, on the last slide, which is on indemnities, where a seller may wish to structure the indemnity clauses such that they exclude claims related to the impact of COVID-19. Thank you very much for this opportunity.
Thank you very much, Mrs. Omulele, for this very good overview of what the key points to bear in mind to close deals at the moment. I want to rapidly address the issue of the heart of the matter, really. We know how to close deals, but where to invest? And I would like to turn to you first, Mr. Lahmar. I've mentioned earlier on this fantastic deal that you have secured in Tunisia in agribusiness. And we've seen with our poll that for the majority of our participants, agribusiness is a sector of future. Do you agree? Which are the best sectors to invest in at the moment, and also the best regions in Africa?
Thank you very much. Thanks, Anne-Marie. Yes, no, absolutely. I think it goes back to what I was mentioning earlier. I think it's very much about industry selection in this kind of environment. And the key is really trying to get exposure to the sectors that are less cyclical, that are not going to move drastically with the economic cycle. And for most countries, or for many countries, I should say, in Africa, there is going to be a recession in 2020. Not all of them. Some economies are lucky enough to be, well diversified enough, and they were on a, let's say, 5, 6, 7, 8%, GDP growth pre-COVID. Post-COVID, they're still looking at positive growth, albeit, modest, but still positive. So it's not all economies that will be in a recession. So that's a positive. So that also, before even industry selection, I would say country selection is important. And to the extent that you can be in countries where, like I said, they're not going to be in negative growth territory, they're still going to be able to achieve positive growth. I think that's a plus because of the diversified nature of their economy and less exposure perhaps to oil and gas and commodity, based type industries. So those are the, I think, economies that are doing relatively better than the others. In terms of industries, yeah, I'm not surprised at all to see the result of the poll with agribusiness, well ahead of any other sectors. That's the view we've taken with CCAM, and I think that's a reasonable view to be taken in this environment. I would also add to that pharmaceutical industry, for sure, has been deemed an essential industry, has been able to operate more or less normally in many of our countries. All their supply chain and distribution chain, I think, is operating more or less normally. And I think that's also a sector that we are at DPI looking at actively, and one that, is, I think, relatively more investable in this environment and in the coming, 6 months. Beyond that, I would also say education, because it is, again, more defensive, less cyclical. People will continue, will have to continue to be educated. Although clearly, digital means of education and distance learning has become huge in that sector, and it is having real implications on that industry. And then retail, I would say, is another big one, and more food retailing and essential good retailing, and less of the kind of more discretionary or less essential kind of retailing, goods retailing. Those are the sectors that come to mind, and I think it's important to also try and, as was mentioned by Esther in her presentation, when you look at deals now and as you advance through them in the structuring of the deal, to try and address some of the impacts that have been felt by, businesses from COVID-19. Certainly, I know in some of our deal discussions at the moment, earnouts are a big, element of the discussion, and to try and basically discount price for the buyer and pay something that would be closer to the seller's expectation on the basis of achieving certain milestone, a certain performance threshold over the next 6, 12, 18 months. So that's also a very important element.
Thank you very much. I would like to ask you the same question, Mrs. Engels-van. Which are the sectors which are key and major for you in this moment to be doing investments?
Right, so what we are definitely seeing in the South African market at the moment is a movement in our energy infrastructure. We can definitely see outside investors and government moving on that. And then we are seeing on an overall public-private partnership, there's a movement of deals with government and public-private parties together, bringing it across the board. The main industries, of course, we see pharmaceutical, very important, health, very important, and the essential retail services, we've seen an increase on that. The last one we've seen is on technology, with the major suppliers around the country coming towards the deal line.
Thank you very much. So I would like to thank you all, to all our participants, because I can see questions from you pouring through. And one of them comes from Tarek Lababidi, and I will address it to you, Mr. Mourimi. Mr. Lababidi is asking, do you expect valuations to change in the short term from the buyer's perspective, from the seller's perspective? And if yes, how long will it take until sellers lower their expectations? Mr. Mourimi, please.
Thanks for the question. Interesting question, trying to predict the future. I think in the short term, and short term here I say next 12 months, I think there'll be a continued and increasing perhaps gap in valuation expectations between buyers and sellers. From the buyer's point of view, essentially what you're buying are future cash flows. And of course, it becomes increasingly difficult to predict these future cash flows the longer we are in the COVID-19 crisis. And so buyers would then take a very conservative view and possibly take the lowest possible view of future cash flows, especially through this COVID-19 crisis. Maybe take a very conservative view of the next 2-3 years of the business's ability to generate cash flows. The seller, however, probably knows the peak of their business, and so can see, has known high cash flows in the past, and possibly takes an optimistic view that will be done with the COVID-19 crisis in short order and go back to generating very high cash flows. So I think there'll be a continued increasing gap in valuation expectations. But I think the longer we are in this crisis, and I mentioned there's both the public health issue and then there's of course the economic consequence. I think the more business is going to distress because of the crisis, and also the fewer options that are available for capital, both debt and equity. I think then eventually the sellers' expectations on valuations, I think, will come down and come closer to where the buyers' valuations are. I think we saw this in the 2008, 2009, where we saw EV/EBITDA market multiples move from a high of 11x a year before to as low as 6x on average. And I think that's a trend that we'll continue to see the longer this crisis persists.
Thank you very much. Again, we'll carry on with our questions from the participants. And there is a direct question for you, Mr. Lahmar, coming from Brian Smith. How does DPI get comfortable managing relationships with promoters and management remotely given travel constraints?
Sure, yeah, no, thank you very much, Anne-Marie. Look, it's a very good question. I think there are existing relationships with existing portfolio companies, and that I think they're well established, well known people to us. We have already a strong relationship with them, and it's just a matter of having to transition all of that, by video conference, Zoom, and what have you, And we've been able to do that very effectively across our portfolio with all of our management teams. And in fact, one of the, I think, positive aspects of this global crisis is that all of our companies that we work with have now, learned to use, Zoom and other video conference tools very effectively. They've gotten comfortable with it. Not that they weren't using it before, they were, but not as much, as the rest of us. We've all used it extensively and are using it extensively. And it's made us realize that we can do more of it and perhaps, become more productive and have some, gains in efficiency in the way we work going forward. So I think that's been a big positive. In terms of new relationships, I think you can start, you can initiate, contact, you can do things remotely as much as possible, but it's going to hit kind of a plateau and a limit in terms of being able to go further and advance in that relationship until you can travel on the ground, meet people in person. And as Fred was saying earlier about DD, I think it's key to what we do, the people aspect. And so I think there's a limit there to what you can achieve in terms of new deals and new relationship and managing that, entirely remotely.
Thank you very much. I have to say that we have some great questions today. There is one for you, Mrs. Engels-van, coming from Kunle Haji, and he's asking, if we absolutely have to do a deal in this period, would it be justified to apply a discount arising out of the pandemic in valuations, or do we perhaps think such a discount will already be inherently captured in country risk or other premiums commonly applied already? Would you like to answer to that, please?
Yes, thank you for the question. Very good question. I don't think, and from what I've seen, that is something that you can inherently apply per country. This unfortunately seems to hit a country very differently depending on the measurements taken or the type of infrastructure per country. Can you apply a discount? Very much so. Yes, definitely seeking from the buyer side what that discount is. Again, it depends on what type of industry you're looking at and how that industry is going to be impacted for the next 12 to 18 months. That's certainly what we have advised on this end.
Thank you very much. And now I would like to read the question from Fabrice Nzekale, which I would like to extend to all three of you. The question is, will the pandemic strengthen collaboration among businesses in Africa, or will businesses revert to their old global supply chains? And this sort of echoes with what Mr. Azevedo spoke about earlier on, notably mentioning China. Mr. Mourimi, would you like to be the first to answer, please?
Thanks for the question. I think again, it depends on how long we are in this crisis. I think if we come out of it quickly, say in the next 6 months, it will be very easy to revert to the global supply chains that we were used to. China, of course, was a dominant supplier into Africa, just given the trade imbalances between different African countries and China. So I think it will be easy to get back to those supply chains. I think if the crisis persists, I don't think it may necessarily become greater collaboration in Africa immediately, but I think we may see more in-country solutions where businesses look for supply chains locally. I say that because right now, say for instance, between the Kenya and Uganda border, we are now seeing miles and miles of traffic, cargo-bound traffic, just because of the time it's taken to clear through the different ports because of the COVID-related concerns. So the longer we are in this crisis, I don't think it'd be an automatic switch to an Africa collaboration, but I see local supply chains strengthening and growing.
Thank you. Mr. Lahmar, would you like to reply to this question as well, please?
I think, generally speaking, one of the fundamental effects in my mind of this COVID-19 crisis will be the acceleration of a trend that had started already pre-COVID, which was to try and diversify away from China. For many, large multinationals, companies, countries, you name it, there was a concentration of supply chain and there was a risk there. And that risk was being recognized pre-COVID and people were slowly trying to address it. I think this crisis has highlighted it, more strongly, and people are looking to, diversify that risk away and build alternative, supply centers and supply places. And I think to that extent, it does create a very significant opportunity for Africa in the medium long term. I don't think it's, but is a definite opportunity for Africa to become more of a manufacturing, center and base for many, global industries in many regions of the world. Certainly, we're very competitive, I think, from a labor and sometimes energy price standpoint. And so there is a competitive advantage to capitalize on. Between African countries, I think it's harder to see. I mean, I agree with Fred. I really see it more governments maybe trying to promote and incentivize local manufacturing in their country, to reduce the reliance on import and reduce their import bill, because in this current environment, and that, with all the currency pressures that countries are facing, that is very much a key element of government policy. And I think to that extent, there will be a lot of policies in my mind trying to incentivize local manufacturing and industrialization, basically, of African economies. And I think that's a positive trend.
Thank you very much. And do you agree, Mrs. Engels-van, this will be, in the end, a positive trend and also a source of new opportunities for the continent?
I do definitely agree. I think the more you are faced and forced to reinvent the old or historic ways, the less you will be inclined to rely on historic ways. And that is certainly proven in human history. So I think this will force the continent and global economic companies to look at that from this perspective.
Thank you very much. And also another opportunity is we've talking about the digital, and one of our participants is asking about e-commerce. Graham Reed is asking, what do you think that the investment opportunities in e-commerce are likely to be post-COVID? Mr. Mourini, please.
Thanks for the question. Thanks, Graham, for the question. So I think there'll definitely be increasing opportunities for e-commerce, just because of the concerns around the infection rates with COVID and possible even future either waves of COVID-19 or other viral pandemics. But ultimately, the growth of e-commerce will, I think, be hinged upon last mile connectivity, because particularly as far as goods are concerned, we still have to find a way of getting the goods to the consumer. And the more efficient we are in getting the goods to consumer, covering that last mile, I think I see e-commerce opportunities increasing.
Thank you very much. And do you agree, Mr. Lahmar, notably in the areas of food?
Yes, no, I agree. I think we've seen it across many of our companies. I think a lot of our companies, given the disruption in mobility domestically, have looked at developing e-commerce channels and digital channels, more generally speaking. And so I think that's a trend that's continuing. It had started pre-COVID. I think the COVID crisis has accelerated that trend. And so we're seeing more of that. And I think the trick with e-commerce, I mean, where e-commerce as such, on a pure play basis, as they call it, is not, for us as an investor, is harder to look at and harder to price, because it's not profitable always, and one has to take a certain view as to how to monetize an e-commerce opportunity. But building an e-commerce channel within a broader business that's already very profitable and using that as a digital delivery channel to accelerate sales, I think makes a lot of sense, and we're seeing a lot of that in many of our companies.
Thank you very much. Well, we've come to the end of our very insightful conversation. You have given us truly gems that I am sure will help each one of us better understand the market and also the tools needed to close deals in these times of pandemic. I would like to thank you, Mr. Fred. Can you hear me? I think we are having trouble. Lovely. So I was thanking you all for your great contribution. Mr. Mohimi, thank you very much. Thank you also, Mr. Sofiane Lahmar and Mrs. Riëtte Engels-van. I would like to say before leaving you that you are all invited to complete a short survey on your experience at the end of this webinar. I thank you in advance for your contribution. As I've repeated all throughout, your opinion is very important to us. Also, I would like to let you know that there is a description of all the upcoming webinars on the Africa CEO Forum website. So please do go over there, take a look. Many of them will be in English, others in French. Also, I would like to remind you of the holding of an exceptional next webinar, which will take place on June the 11th with the newly sworn in Secretary General of the African Continental Free Trade Area. And you will have the opportunity to answer all your questions, of course. And the theme of our next webinar is COVID-19. What is at stake for the African Continental Free Trade Area? So again, a key issue to be addressed for everyone doing business or looking to doing business in Africa. It is my pleasure to have been your host today, and I look forward to seeing you all again during our next webinar. I would also like to thank Mr. Miguel Azevedo, Mrs. Esther Omulele, and also Mrs. Toyin Sanni for having taken part in our conversation. Thank you all.
Thank you, Anne-Marie, and thank you, Riëtte and Fred. Bye, everyone.
Thank you. Bye, everyone.
Bye, everyone. Thank you.